As many of you will know, the fabulous new look Philip James Independent Financial Advice, formerly Philip James Financial Services, name changed so it does what it says on the tin, has some fabulous younger advisors. They can and often do educate me in the technicalities of what we do, as they've had to pass more exams much more recently than me, the more mature member of the team. However, if you've ever tried to learn a language from a book or at school, you'll know from having a go on holiday that the learning and the using can be very different things. It's the same in my experience with computers. Unless you do it, all the instructions from an IT person and certainly anything you hear in the classroom is useless. Just get stuck in on both counts. And it's the same with many of the things that we do and advise on, putting the theory into practice with actual real people who want actual solutions to their financial, not problems, but we could be a little pretentious here and say their hopes and aspirations. That can often take you in very different directions to those you might have expected. Our younger advisors know very well what an annuity is and does. If you don't, I'll tell you in a minute. But fitting them to someone's real life, finding out who they should use and setting one up can be very different. So, let me explain first of all what they are. An annuity is an annual income. To get the income, you pay a lump sum to a pension or life insurance company. In most cases, your lump sum disappears and you get an income for life in return. I say in most cases because there are annuities which offer a return of your capital or the money you've paid, or pay you for a fixed number of years. But the most common, which I'm going to talk about here, are pension annuities, where you give up your pension pot in return for that, well, what now seems old-fashioned, pension for life. Now, the setting up of annuities was once meat and drink for we older advisors, as until not so many years ago, this was pretty much all you could do with your pension fund. You take your tax-free cash, put it in the bank or invest it with us, thank you very much. We'd then shop around to get the best income from the rest of the fund that we could, or can, as that's what we're starting to do rather more often now. You'll get the highest amount of income each year or month if you have an annuity which stays level and dies with you. You can build in a guarantee that it will be paid for at least 5 or 10 years, so that if you keel over in the first year, your family gets the income for another 9 years, in the 5th for another 5, and so on. You can make it joint life, so that it carries on until usually both husband and wife die. And this and all of these options bring down the starting level of income you can get, as does, to the biggest extent, including index linking, so that the income goes up each year either by a set amount or in line with inflation. For those or most who want a guaranteed income, and those are the ones who should be considering this, the 10-year guarantee option probably gives the best value. And different providers will offer better or worse rates for different types of annuity, which is where our independent label comes into its own. Now, if you've had an illness, or are or have been a smoker, much rarer these days, you could get a higher income, because an annuity is essentially a bet between the annuity company and you. They do best if you die soon. You want to be paid for as many years as possible. The results are, of course, usually somewhere in between. The application process is, of course, more complicated if an ill health or smoker annuity might fit the bill, as they'll want some medical evidence. Otherwise, once we've agreed who we'll use, we'll work out the best way of organising it for you. If you have a number of pensions, we transfer them all to the annuity company. They pay out the tax-free cash and set up the income. If it's just one pension, the pension company you're with can pay the cash and then transfer. That's called the open market option. Why is the tax-free cash always paid? Well, because annuity income is taxable, and whatever you do with it, you should take advantage of the tax-free bit, even if it's invested, say, in an ISA or ISAs to give you more income. Now, there are other nuances and options, but for most people, that's it. So why do many in our world then not have much or any experience of annuities? Well, because since pension freedoms came in 10 years or so ago, moving pensions to drawdown has been, for pretty much everyone, the better option. You keep access to your funds, and more importantly, annuity rates are linked to interest rates, as the annuity company usually buys government bonds in the background to secure your income. When interest rates were a quarter, a half, or even 1%, the amount you get for your pension fund trade-in was not at all attractive. And of course, pension funds were free of inheritance tax, another reason for keeping your pot to pass on. Now, you can't get an annuity that will pass an income on to your kids, so you could say that 60% of something is better than nothing. But both that and more attractive annuity rates are making many think again. So, like much in many or most parts of life, we're heading, if not full circle, certainly in a bit of an ellipse, or something like that. You get my meaning.